For the longest time, I thought we were on the cusp of repeating the 1970s. A lot of folks have pointed out the fact that Zuber, you're an idiot. You're wrong. It's going to be a lot more like the 1950s. Folks, this is an important decision. Are we on the cusp of repeating stagflation, or are we on the cusp of a great decade of growth? We're going to have a conversation with Mr. Dan Bird, who has taken on this challenge. Are we in for a repeat of the 50s or the 70s? I'm ready to pay attention. How you doing, buddy?
I'm doing good. Would it shock you to learn that I don't agree with either of those?
No, it would not shock me at all. I've known you for decades. I'm not shocked by that at all.
And I'm going to show you why here in a minute.
Awesome.
I think it is more like the 20s.
Oh, snap. The 1920s for a right turn. Okay, let's go. Tell me about it.
1920s. All right, so let me share because I need some visuals for this one.
You and me both.
All right, so here's I'm going to actually use my newsletter for this one. But if anybody would like the newsletter, just go to breakpointtrading.net and click on this button right here for the free newsletter. And I'm going to use that. But one of the things that I mentioned to you in a text, I believe, when I watched your video about the 50s versus the 70s, and the one thing that I said was the 50s was a secular bull market.
Right.
The 70s was a secular bear market. And it's really, really important that in all of these conversations, especially when you're trying to compare different periods of the past, that you remember that fact. Don't lose sight of secular markets. They're very powerful. In fact, it is so important that on the homepage of my website, right down here, this is the current secular markets for the last 30 years, 34 years for the S&P. The green are secular bulls, the red is secular bears. Secular bears usually last roughly 12 years. It doesn't have to be exact, but 12, 14 years. Secular bulls typically last roughly 18 to 20, something in that range. The last secular bear ended officially when it broke out above the 2000 and the 2008 highs. You see that right there?
I do.
So that's when the secular bear ended. Now, inside of that secular bear, there was a cyclical bull. From 2003 to 2007, it was a great run. Could have made a lot of money in the stock market during those 4 years. But it was still inside of a secular bear market. All right. The secular bull started officially in 2013, or you could start counting it from the 2009 low if you want. But either way, it should run until 2029 to 2033, somewhere in that neighborhood. So we are currently in a secular bull market. And these are the three indicators that I watch, and I update this chart every week. You can see the date right here, June 7th. So that's Friday. This is updated every week, and I will keep an eye on this. And every time it gets close to this crossing this line down here, I put a little blue arrow just to alert people that it's coming. But it never did cross. This one here hasn't crossed, and it hasn't closed below the 200-week moving average. Even COVID, while it went below it, it never closed below it. All right. Secular bull, secular bear. Secular bull is 81 to 2001. And right in the middle of that secular bull was the 1987 crash, which is not on this chart, but it's back here somewhere.
Right. Yep.
But it was still within a secular bull. So it didn't affect the trajectory of that bull. You can see it's still above the 200-week moving average down here. Just like COVID and the trade war and the 2022 cyclical bear market did not affect the secular bull. They were cyclical, just like this bull here was cyclical inside of a bear. All right. So really important. So when you're comparing the 70s to the 50s, and I'll show you a longer term chart here in a minute, the 70s was a secular bear. Not a good thing. 50s was a secular bull. So if anything, I would compare this more to the 50s than the 70s for that reason. That's also the reason I would not say we will have stagflation. I don't think we'll have stagflation. Now, stagflation is defined by three things, not just two. Defined by slow growth, high inflation, and high unemployment.
Okay.
Those are the three things that cause stagflation. In the last video we just talked about, I demonstrated how I think inflation is going below 3%, even though the unemployment rate is creeping up. And it remains to be seen what the growth rate is going to be. That's probably going to, level off, and that probably will be stagnated, that piece of it.
Sure.
But I don't think we're going to have all three of those together.
Okay.
One of the reasons is that we are in a secular bull market. So the economy and the market is not going to crash until sometime in this period. By the way, you know what else happens? And I put this in the newsletter this week because I just discovered it. I didn't know this. You know what else happens in 2029?
No.
The asteroid Apophis could crash into the Earth.
Oh, stop it. Okay.
I'm serious. Apophis is the Greek god of chaos and destruction.
Oh, great.
It will come closer than it ever has. And if the math and the scientists are off by just even a little bit, then it could hit the Earth.
Oh, great.
And 2029 is also the 100-year anniversary of the 1929 crash. So I'm becoming more confident that the next secular bear market is going to be around this time frame.
This whole asteroid thing.
Right. It's pretty interesting, actually. All right, so I'm going to open the newsletter right here. Of course, I got cartoons. Here's the consumer.
Yeah, not good.
Jobs numbers putting along. All right, so here's next week CPI. This was as of Saturday, and they're forecasting 3.4 right there. We didn't talk about PPI, but PPI is forecasted to go down quite a bit.
Yeah,
but PPI is very volatile, so it's hard to say what's going to happen. There's what we already talked about. There's stagflation. I talked about that a little bit. Here's what I wanted to show you. This is a longer term secular bull and bear market.
Okay.
So secular bear, 1950s was during a secular bull, 1970s was a secular bear. All the stuff I just talked about. So here's the chart. So here's secular bear, 2000 to 2013.
Yep.
Here's a secular bear, 1966 to 1980. 70s is right in the middle of that. Here's the other secular bear back here, 37 to 1950. So that's 13 years. This one here is 14 years. This is 12 years, 13. This was interesting, generational lows. 1942, 1974, 2009. All within secular bear markets. And then you can see what the secular bulls look like. There's the 1987 crash.
Yeah, largest one-day crash on record. Yep.
Yep. But barely put a dent in the secular bull. In fact, I would submit, based on the run that it had before that, the market needed to do that.
Yeah.
It needed to do that. But it did not interrupt the secular bull trend. Just like COVID here did not interrupt the secular bull trend. All right, and back here, this is from 1950. So here's the 50s, 50 to 66. Here's the run. There's 1957, cyclical bear, in the 7th year of a secular bull. This was the 1987 crash in the 7th year of a secular bull. here is COVID in the 7th year of a secular bull.
Hmm.
It's amazing how symmetrical the market can be sometimes.
Yep.
It's really important to remember this when you're thinking about, what this period looks like versus other periods, or what we're going through, or, is the market going to crash, or is the 2022, when the market was in a cyclical bear, was it going to continue and market will just go back down to the COVID lows? Well, no, we are in a secular bull. So no, that's not going to happen. That's not going to happen until the secular bull market is over. So don't ever forget this. This is 100 years of history right here.
I like it. Okay.
Interesting stuff, huh?
Yeah, I like it.
One of the other things that I also put in the newsletter, and I've now put it on the website, it's one of the new things. And I showed you this last week when we talked about, the big run last Friday, the Friday before last, I should say.
Yeah, I remember.
So I put, this is a daily chart. So these are 10-minute bars, 5 days. This is 1 week's worth. So we can look at what the market did. This is the S&P for the whole week, from Monday to Friday, sold off, and then started back up again. And here are the sectors. Technology recovered, had a great week. Financials sold off and had a bad week. Discretionary, these are, by the way, in order of their weighting in the
I like that you added the weighting. I like that.
Yeah, it's the weighting. I didn't know what it was. I said technology was 40% last week, but it's really 30%. But these are the weightings, and I rank them based on. So the first ones are the aggressive sectors, and the next ones are the defensive. So financials sold off, discretionary kind of hung in there. Communication services, the internet companies actually went up a little bit, but then by the end of the week on Friday in particular, sold off. So, the market in general didn't look too good. Industrials, the whole week sold off. Healthcare actually looks pretty healthy for healthcare. Staples sold off on Friday. Energy had a bad week, just right from the beginning. Here's utility. This is from Staples down. These are the defensive sectors. So energy didn't do too well. Utilities, the most defensive, didn't do well. Materials didn't do well. So all the defensive sectors down here didn't look too good. It's really technology that's holding everything up. That was the key. So I'm going to put this in the newsletter every week.
Nice.
So people can see what happened during the week, which of the, I always put in this, which shows you for the week. Actually, this right here.
There we go.
So you can see what the sectors did, and you can actually see, the ones above the S&P are the ones that outperformed, and they are basically all aggressive sectors. And then this is the rotation graph. So even though the aggressive ones outperformed, they are moving lower. So the trend doesn't look too good. So that's not a good thing. And then take a look at Vector Vest. So there is a divergence, or I don't know what to call it, dichotomy in what I'm seeing in the market right now. A bifurcation, maybe that's the right word. Vector Vest looks terrible, doesn't it?
Yeah.
It's red and yellow, and it gave a confirmed call the Monday before last. Actually, yeah, actually last Monday. Monday of this week gave a confirmed down signal.
Yep.
And then on Friday of this week, this is the intermediate signal, also gave a down signal on Friday after the close. So 2 down signals from Vector Vest. However, if you look at my website, I update the Investors Business Daily, IBD. This also changed on Friday. So market and confirmed uptrend. S&P, NASDAQ climbed to record highs, raised exposure to 80 to 100%.
Oh my gosh, somebody's wrong. Somebody
is wrong. So why is that? My opinion is that IBD uses, the major indexes, the NASDAQ and the S&P and the Dow, where VectorVest uses everything.
Yeah, the entire market. Yep.
The entire market, 9,000 stocks, and that includes ETFs. So they have a much broader view of all of this, but I can't tell you which one's going to be right. But if VectorVest is right, then that does not bode well for that CPI number on Wednesday.
No.
Here's the earnings. Earnings actually look pretty good. This is the earnings trend right there. So earnings are trending higher. And then I put my own earnings chart that's on the website. So this is a monthly chart, S&P. Here's the PE ratio down here. And earnings, you can see how earnings all the way back to 2009 had a little blip here after COVID. But in general, earnings have just been moving up. It's really interesting when I created this. It was interesting to me to see the two bubbles here, where the PE ratio soared higher when the market sold off big time. Same thing here. And I mean, it kind of makes sense because PE means price to earnings, right? And price was taking a nosedive. So earnings were still okay. So it made these numbers look much higher.
Interesting. Okay.
Yeah. And then the VIX is ridiculously low.
Wow.
So the VIX is not telling
that
us
might change. That might change Wednesday. Maybe
that could change Wednesday. And if you look at the momentum for the VIX, it's already started to move up. So everything that we're seeing right now, this is the 10-minute chart for the 10-year. We didn't talk about the 10-year yet. So this is the 10-year. And you can see what happened on Friday with the jobs number.
Yeah, it was a crazy move.
Yeah, spiked up to 4.4. And if we get a bad CPI, it's going to probably spike higher.
It'll go again. Yeah, absolutely.
And that's not going to be good for the market either.
Nope.
So here's GameStop. I did a little calculation just for fun. But I made a point of saying in here that this is just for fun, and there's no way you can actually catch the top and the bottom of these moves. But the bottom to the top right here in 3 days, 260%.
Wow.
And then from there, in the next 3 days, down 70%. So imagine the people that saw the move on the first day and decided, I'm getting in at the open because GameStop is moving again. What's his name? Roaring Kitty. Roaring Kitty is making it move, so I'm getting in, and they buy right here at the top. And 3 days later, they've lost 70% of their portfolio.
Yep.
Right.
Gambling.
And then it kind of moves sideways, and right here goes up 108%. And then on Friday, in 1 day, came down 45%. So where do you get in? Do you get in after it's moved and lose 45% or 70%?
You don't touch it, Dan. You know that. You leave stocks like this the freak alone.
Now, when this one over here happened, I decided, because I have a chart list that comes from Tom Bowley of all of the stocks that have more than 20% of their shares short, or in other words, borrowed in order to sell them. And so I take that list and I run a scan against it. So I'm looking for things that have greater than average volume, the price is moving up, a number of different things I'm looking at. And then I'll send out to my subscribers, I'll send out a short squeeze alert. And I make a point of saying, this is not something to trade if you don't know what you're doing. It's not for long-term investors. But my short squeeze would have triggered right here on this one. And if all you did on these short squeezes is just put a buy order just right above the high for the day, it would have triggered right here. And 4 days later, you'd be up 260% if you got out. If you got out.
Yeah.
Now, Roaring Kitty did not get out.
Nope. That doesn't appear so.
Is still in, as far as I know. Right.
Yep.
And he's in with mostly options.
Yeah, I think his strike price is 25, I think. And I think the
Okay.
stock's at 28. I think last
All
time I
right,
saw
so
it.
strike price at 25 which is right where it's at, or where it came down to. It actually closed at 28, but it came down to 26 was the low. So he's losing money because time
Is he?
decay,
Oh, yeah.
time decay is going to deplete his profits.
Okay.
And the way, by the way, for options, the way time decay works is there is what's called an expected move. So when they price options, most stocks usually trade within 80% of the time, they trade within a range. All right. So 80% of the time, they're in the range of that expected move.
Yep.
And options are priced for that.
Right.
So if you ever bought a call option and the price went up, but it didn't go up a lot, and you lost money.
Right.
And you're like, well, how did I lose money? I was right. It went up.
Yeah.
Well, that's because that expected move, that range that it's trading in, is already priced in.
Right.
And every day that goes by, your option is losing money.
Right.
So if he has a $25 strike price, what you know what the date is?
Oh, it's this month. It's the June 21st, I think.
All right. So time decay happens fastest in the last 30 days.
Yeah.
So he's already losing money. So all the money he could have made if he had got out right here, he's giving it all back. So
yeah,
he
very
is
cool.
he is in the negative right now.
Yep.
Here's my little experiment. So this is just assuming that you get out the exact top and the exact bottom. You would have made 11 on a $1,000 investment. You would have made $1,100 or 10% in those roughly 14 days.
Cool.
Or you would have had a portfolio value of $550. And then here's the asteroid Apophis.
Yeah.
I think everybody. This is Neil deGrasse Tyson. He's
famous.
Very famous scientist. He's the one that explains why it's going to come so close and could even hit the Earth if the scientists are off by just a little bit. And then once it whips by the Earth in 2029, if it comes that close, then something will happen with its trajectory. Apophis comes back every 7 years. So when it comes back in 2036, it might actually hit that time.
Oh, great.
Even if it misses this time, but if it gets close enough, it's going to change the trajectory. 2036, it could hit. This one down here is a pretty cool simulation of Apophis and how it's coming towards us.
Great. More stuff to worry about.
Yeah, get the newsletter. You can watch those. It's pretty interesting, actually.
There you go. All right.
All right.
Well, there you go. Yeah, Mr. Dan Bird, you are amazing. Thank you for coming back each and every week. One more time, show the website, please.
Breakpointtrading.net. And here's everything I just showed you is right here in the newsletter.
There you go, folks. Go get it. Sign up for the free newsletter and get it every weekend. Thank you, buddy.
All right.